Again, the loss isn't erased. It's redistributed. There's also the public debt angle. When governments borrow heavily to fund bailouts or stimulus, debt to GDP ratios climb. Servicing that debt requires future taxes, spending cuts, or monetary accommodation. Future taxpayers, often younger generations, inherit obligations they never voted for. But during the crisis, that cost is abstract. The immediate fear is concrete. No leader wants to be remembered as the one who let the system fail. Very few are punished for expanding debt during an emergency, so the bias toward rescue is strong, almost automatic. Now here's where the story gets even more complicated. Sometimes rescues are necessary. When financial plumbing freezes, even healthy businesses can collapse. Payment systems can stall. Ordinary people can lose access to deposits. The domino effect is real. Letting everything burn isn't a serious option in a modern, interconnected economy. The question isn't whether to intervene. It's how. Do you wipe out shareholders before offering support? Do you impose losses on bondholders? Do you attach strict conditions? Do you break up institutions afterward? Do you reform incentives once stability returns? Or do you stabilize first and promise reform later? History suggests that later rarely arrives in full, because once calm returns, urgency fades, lobbying resumes, markets recover, political attention shifts. The rescue becomes a footnote. The structural risks remain. And this is where popular narratives often diverge from reality. In public discourse, economic rescues are framed as heroic interventions, leaders standing between chaos and order, technocrats pulling levers to save jobs and pensions. And to be fair, many interventions do prevent immediate catastrophe. But the deeper story is less cinematic. It's about trade-offs. It's about choosing inflation over bankruptcy, debt over default, gradual erosion over sudden collapse. It's about deciding which pain is visible and which pain is deferred. And most of the time, the deferred pain wins. There's also a power dimension that rarely gets airtime. When central banks and governments repeatedly intervene in markets, they gain influence over credit allocation. They decide which assets to buy, which sectors to support, which institutions qualify for emergency facilities. That shapes the economy's structure. Certain industries become implicitly protected. Certain firms grow large precisely because they're seen as indispensable. Over time, the line between free markets and managed markets blurs. And with that blurring comes concentration. Large players survive downturns. Smaller competitors fail. Market share consolidates. The system stabilizes, but it also centralizes. So here we are. Every economic rescue offers immediate relief. It calms panic. It prevents cascading failure. It buys time. In exchange, it often increases debt, reinforces moral hazard, redistributes losses quietly, inflates asset prices, and concentrates power. Stability today, constraints tomorrow. The unspoken trade-off is not good versus evil. It's short-term versus long-term. Visible pain versus invisible cost. Systemic collapse versus structural distortion. And the more often we choose rescue without reform, the narrower the future set of choices becomes. Because each intervention builds expectations. Each expectation encourages risk. Each cycle requires larger tools. Eventually, you reach a point where the system can't tolerate even modest pain without extraordinary support. That's when the trade-off becomes existential. If the next crisis demands a rescue so large it strains currency credibility or public finances, what then? If inflation resurges but markets are addicted to low rates, which do you protect? If debt is already massive, how do you fund the next bailout? There is no painless option, only different distributions of pain. And that's the uncomfortable truth hiding behind every emergency announcement and every late-night policy meeting. Economic rescues are not free. They are not neutral. They are choices about who absorbs risk and when. Markets are falling. Headlines are screaming. Politicians are promising action. And then, behind closed doors, a small group of people decide to save the system. Money appears. Rules bend. Institutions that were hours from collapse suddenly survive. And almost nobody asks the most important question. Save for who? Every economic rescue comes with a trade-off. It's rarely discussed. It's almost never voted on. But it shapes who gets protected, who absorbs the losses, and who quietly pays the bill years later. And once you see it, you can't unsee it. Right now, this matters more than ever. Debt levels are higher than at almost any point in modern history. Governments are stretched. Central banks are cautious. Markets are fragile. The next rescue, whenever it comes, won't be theoretical. It will be personal. To understand the trade-off, we need to strip away the drama and look at the mechanics. An economic rescue usually begins with fear. A bank can't meet withdrawals. A major company can't roll over its debt. A market freezes. Credit, the oxygen of the economy, stops flowing. And when credit stops, everything else follows. Businesses can't borrow to pay wages. Consumers can't finance homes or cars. Investors can't refinance positions. What looks like a Wall Street problem quickly becomes a jobs problem. So governments and central banks step in. They inject liquidity. They guarantee deposits. They buy assets. They lower interest rates. Sometimes they print money outright. On paper, the goal is simple: stop panic, restore confidence, keep the system running. But here's the first uncomfortable truth. A rescue does not erase losses. It moves them. If a bank made reckless loans, those loans don't magically become safe. If an asset was overpriced, it doesn't suddenly become worth more. The losses still exist. The question is who absorbs them. In a pure market system, investors and creditors would take the hit. Shareholders would be wiped out. Bondholders would lose money. Bad decisions would have consequences. But in a rescue, the pain is often redirected. Depositors are protected. Large institutions are stabilized. Markets are backstopped. And the losses are spread across society through inflation, higher public debt, or slower growth. The immediate crisis is avoided. The bill is postponed. Take a simple example. Imagine a large bank has $100 billion in bad loans. If it fails, investors lose money immediately. That's visible. That's dramatic. But if the government steps in and guarantees those losses, the bank survives. Depositors feel safe. Markets calm down. Where does the $100 billion go? It becomes public debt, or it's absorbed by a central bank's balance sheet, or it's diluted through inflation over time. Instead of sudden, concentrated loss for a few, you get a slow, distributed cost for many. That's the trade-off. Short-term stability in exchange for long-term burden. And politically, the short-term almost always wins. Because crises are loud. Unemployment spikes quickly. Stock markets collapse in weeks. Political careers can end in months. The long term is quiet. Debt accumulates gradually. Inflation erodes purchasing power slowly. Asset bubbles inflate over years. It's easier to rescue now and explain later, but there's another layer. Rescues don't just move losses. They change behavior. If large institutions know they are systemically important, too interconnected to fail, they behave differently. Risk feels cheaper. Leverage feels manageable. Profits are private. Catastrophe is public. This isn't a conspiracy. It's incentive design. If you know that in a worst-case scenario someone else absorbs a tail risk, you take more risk. Not recklessly, rationally. Over time, this shifts the entire financial culture. Balance sheets expand. Debt grows. Asset prices climb higher than fundamentals justify. Because deep down, markets start to assume that when things get bad enough, someone will step in. This expectation even has a nickname in financial circles. The idea that central banks will cushion major declines. It's rarely stated explicitly, but it's priced in, and that changes everything. Here's the irony. Rescues are designed to prevent collapse, but by softening consequences, they can make the system more fragile over time. Imagine a forest where small fires are never allowed to burn. It sounds protective, but dry underbrush builds up. When a fire finally breaks out, it's massive. Financial systems work similarly. Small failures, small bankruptcies, small corrections. They clear out excess risk. When every downturn is aggressively suppressed, risk accumulates in hidden corners. Then the next crisis is bigger, and the next rescue must be larger still. Look at the trajectory. Each major crisis tends to require more intervention than the last. Bigger asset purchases, larger guarantees, lower interest rates, more unconventional policies. Why? Because the system becomes more dependent on support. After repeated rescues, markets start reacting not just to economic data, but to central bank tone. A few words in a press conference can move trillions of dollars. That's not normal capitalism. That's a highly managed ecosystem. Now let's talk about inflation, because this is where the trade-off becomes tangible. When central banks create large amounts of money to stabilize markets, that liquidity doesn't stay neatly contained. It flows into assets, stocks, bonds, real estate. Prices rise. Asset owners benefit first. Over time, if money growth outpaces real economic output, consumer prices rise too. Not always immediately, not evenly, but persistently. For someone holding significant assets, rising prices can be a feature. For someone living paycheck to paycheck, it's a tax. A rescue that prevents a market crash today may contribute to a higher cost of living tomorrow.